Hey guys, Dylan here, and I'm joined by
Angela.
And we are super excited this morning to kick off an entirely new mini-series that we're putting together for you over the next several weeks, really on listing management.
Yeah.
And we've got a lot of great material planned. We've got some really good resources for you. We're actually going to be putting this together as a course as well, so you can get some CE in the future. But we really feel like now is a very important time to jump into, I wouldn't call it a new topic.
Yeah.
We're revisiting some old content, but I think it's never been more timely. And as we've spent a lot of time thinking about where we need to focus our energy, our attention as a team, as a collective, as an organization, and as individuals, I cannot think of a more important time to brush off some old skills, rethink through some things, because there's some big change in the air right now.
Yeah. And I think the big point for me when you said some of this to me the first time was a lot of our people weren't around in what we're going to go through here next. So I think that for some people, it is not even relearn or brush off. It really, truly is learn for the first time.
So welcome to our listing management mini-series.
Yeah.
We have a new jingle.
Yeah, we do. I like it.
Guys, I want to start with the bottom line. Bottom line up front. I'll try and summarize really everything we're covering here over the next several weeks. But we're going to dive into each of these topics in depth because they each really are deserving of a lot of our time.
Mm-hmm.
And I think we got a lot of work to do to prepare ourselves for this next year. So here's the bottom line. We are entering a new era in real estate. It might not feel like that just yet, but we are really where we're headed is into a normal market. Mm-hmm. And the reality is that we have not been in a normal market. We'll define that here in a minute for quite some time. The second point, in terms of bottom line up front, most of you listening to this and most of our colleagues in the marketplace, if you look at the 1.6 million real estate licensees, the 1 million realtors, and the several thousand agents in the state of Iowa, the vast majority, I think it's 70 to 80% of them, were not around in the real estate market the last time we had what's called a normal market.
Yeah.
And that's a really important flag in the ground to consider as we think about, as change happens, how prepared are we or aren't we as a collective? Mm-hmm. The third point I want to make is that we, as a function of this, there's a reset that needs to happen right now. And we need to reset a whole bunch of expectations and thinking. And when I say reset thinking and expectations, I don't just mean, I think I mean ours.
Yes.
And I mean for our clients. Mm-hmm. And then finally, we have a whole bunch of skills and capabilities that we need to either learn for the first time or relearn. And if none of this makes sense to you yet, the goal of this first intro topic today is going to be really to jump into the changing era and help you guys understand why we believe there's a massive change that's occurring in our marketplaces right now and what that looks like, just to give you some historical context and then maybe map out the course of where we're headed for the next several weeks.
It's like the essential foundation, right? So each of these, we definitely want you to be sure to follow along, especially for this first one. There's going to be some really great context for you on the piece of paper. So make sure you do have that and follow along with us as we cover, because this first one really is all about setting the foundation for understanding and then where we're going next. Yeah.
So if you have not yet, there is a 2-page resource for this particular episode, and there'll be resources for all the others as well that we really want you to print. And so if you don't have that in front of you right now and you're listening along,
push pause.
Unless you're driving, in which case I guess
please don't.
Sorry. But I really do encourage you guys to have this piece of paper in front of you so that you can take a look at the data and understand it. It'll absorb much better that way. Okay, so let's jump right in.
Yeah, let's do it.
We are entering a new era. And the way I've thought this through is over the last 25 years. And I suppose we could go much further if we wanted to, but 25 years is about the history that we've got as a company. It's how long I've been in the business, early 2000s. And really, there's a handful of agents in our company that were around in the late 90s, but very, very few.
Very few, yeah.
So what we've done here, guys, is really thought through the last 25 years and the various eras that we've gone through in the real estate market nationally, locally. It all matches pretty well.
Yeah.
And so I'm just going to break these down for you one at a time. So let's go back all the way if you can try. I know most of you, what did I say that you were?
Not even born.
You were not born yet. So some of you were not born yet. Some of you weren't born as realtors yet.
Yes, I was not born as a realtor
Well,
yet.
you were born when as a
In
realtor?
2014.
And we had a big crew of people in 2012, 13, 14, 15. And that's a large cross-section of our organization. So 2000 through 2006 is a heck of a long time ago. I was licensed, I think the end of 02, maybe 03 is when I had my start. And I'm going to suggest that that period of time, that era, is best defined. Well, I'm just calling it the old normal. And I'm going to say that it's the last time that we actually experienced a normal market.
Yeah, a balanced, steady, healthy, normal market. Yeah.
And even then, there were a lot of idiosyncrasies. There was a lot of weird stuff going on, and every era had changes that were happening. That was big on the internet was a big thing. A lot of online leads started in that era. Realtor.com was a big thing back then, and the MLS going online was a big thing. And for the first time, we had digital cameras. But what was really going on there underneath any superficial changes that were going on was we had a fundamental balance between the buyer pool and the seller pool.
Yeah.
We had approximately a 6-month supply, which is what we've historically always called a balanced market. And if you look at page 2, just a reminder for any of you, the distinction between buyers and sellers markets, we know that 5 to 7 month supply is what we call a normal or balanced market because the weighting of buyer demand and the amount of available inventory offset each other to create somewhat of a harmony and keep things relatively steady.
Yeah.
It was a balanced market, and what I experienced when I entered real estate was a normative, it was entirely normal that properties sat on the market for somewhere between at least 60 to 90 days.
Yeah.
Some of them would sit as long as 180, and very, very seldom, once in a blue moon, something would sell in the first 20 days or 30 days.
In the first month or so,
And it was an interesting time because if something sold in the first 20 to 30 days, there was an immediate amygdala reaction that you would have. It was an, oh crap.
We underpriced
this property. We lost our clients some money because it was a fundamentally different world where time on market was not just normal, it was necessary. It was necessary in order to create a volume of exposure over time that ensured that the right number of people had actually seen the property for there to be a realistic expectation to maximize the return for the seller. And I'm just going to start there because that is a completely asinine and counterintuitive idea for 80% of our realtors right now.
My brain is definitely not wired that way from what I've experienced.
It's a rewiring. It's a good way to put it. So in this environment, guys, we had somewhere between 2 and 2.5 million homes. This is single family real estate for sale nationwide.
Actively sitting on the market.
And when I entered the market in this period of time, rates were north of 6%. They were somewhere between 6.5 to 7, 8%, depending on the year. And we viewed that as just
normal.
Fine. It was good. This is what it cost. Now, what was working in our favor then is prices weren't quite as inflated as they are now.
Exactly.
We hadn't just gone through a big real estate boom, but it was the beginning of really government intervention to start to make more real estate accessible.
Appealing or accessible. Yes.
There was a big push for housing. The American dream was everyone should try and own a home.
Yep.
So if you can just put yourself in the mindset of a marketplace where there's 6 months supply, there's a lot of buyers, but there's no rush. You got a lot of sellers, but they're patient. They know what it takes to sell a house, and it takes a good 90 days. And an agent mindset where we enter every listing with the expectation of a 90 days on market as being not just, oh no, we have to put up with 90 days. This was what we not just expected, it's what we wanted and planned for.
Yeah.
And this was a healthy way to sell a property. And if I look across our company right now, I can count on maybe 2 hands the number of our agents that were around during this era.
Yeah.
So for those of you that are super old, congratulations. But I will say that in reflecting on that era, I realized how much of that thinking and those skills, even having been through that, I would need to brush off in this environment right now.
It just hasn't been that way.
So something changed around 2005 nationally. And it didn't show up here
in
until
Iowa,
late 2006, and we really felt it in 2007. And what happened is the fundamental collapse of really the entire economy, the Great Depression, But the Great Depression the Great Recession.
Recession,
the Great
yes.
Recession.
Wrong decade.
What defined the Great Recession is that it was a real estate recession.
It was fundamentally started because of some stuff going on in real estate. Yeah.
We caused it. And obviously that marks the end of one era, the normal market, and into the beginning of what I would call the last 20 years.
Yeah.
We have not yet been normal since that
come
crash.
back from all the way. Yeah. Yeah.
And it makes sense. It was the largest impacted real estate scene, and frankly, the U.S. has seen to its economy. We were on the brink of collapse, and we haven't seen anything since the Great Depression in the 1920s.
Yep.
And I think many of you were around for this. Some of you weren't. So real quick, here's what happened.
Yep.
Markets came undone. No one wanted to or could buy properties anymore because they lost significant amounts of their value. Mm-hmm. Tons of new construction and new developments were on the market, and no one wanted to touch them or buy them.
Yep.
And so you ended up with a massive, massive amount of supply. And if you look at the numbers on the chart, we went from 2 million, which was a normal amount of properties for sale, to as high as 4 million. We doubled the amount of properties available for sale in the U.S. And at that same point, the buyer demand fell through the floor.
They were not wanting to buy. It didn't seem safe. Like, it really did change fundamentally the way people thought about real estate, I think.
Simultaneously, as prices collapsed, significant amounts of that inventory was distressed. So a bunch of it was now bank-owned. Banks took all these properties back because builders, developers went out of business, and people just stopped paying their mortgages.
Yep.
All these properties went back to the bank, and they were sold for massive discounts, or frankly, not sold. They just sat.
Yeah.
And then a whole bunch of people had to try and sell their properties as short sales. Mm-hmm. And this was, again, I'm thinking of people in our team right now who were categorized by this era because this is when they started.
Yeah.
Imagine starting real estate in the middle of the great real estate recession.
Yeah.
And all you know is the first thing you learn is short sales.
Yeah. I can't,
How do you help people get out?
I can think of a couple people that I go to specifically for short sale information because this is where they started.
And we were certified distressed property experts, and we were foreclosure experts, and our clients were banks.
Yeah.
And so, it's an interesting period of time. Days on market went way up. We've got 90 through 120 here, but it was absolutely consistent to have properties on the market for 180 to 365 days. Several of them were actually on the market for 2 years at a time.
Yeah.
And this was just understood. They were also sold for 70, 80, 90% on asking price. And it didn't matter, frankly, how much you dropped certain properties. Some stuff just wasn't going to sell. And that defined an era.
Yeah, I was thinking, the thing that I was looking at here was that strong buyer's market. My brain has never really lived through the buyers have the power, the buyers have the control, the negotiating power, like 70, 80% list price to sales price ratio. I've never seen that on our data sheets when we've created data since I've been in real estate. So I was even thinking perhaps that was, I really do feel like investors found opportunities in that space because they bought stuff way discounted and they've just then sat on it, I think, since then.
Yes, it was a marvelous time to be an investor, and I was broke.
I know. Who had the ability to do that?
I'd pay a lot of money to go back to that time and be able to buy what was available for sale at that point. And I don't think we'll see this again in the next 30 years, but I do think, eras come and go.
Yeah.
These cycles
cyclical.
And we will see opportunity again.
Yes.
It just might not be quite as big as that. But that was an absolute buyer's market. Mm-hmm. With what was the supply? What did we list there? 8 to 11 months.
Yeah.
And by the way, these numbers that I've put in here, these are national averages for that period of time.
Got it.
Some of them are a range because what I'm giving you is the range throughout those years. It's the average per year.
Yeah.
And then the range over that period of time.
Makes sense.
So some of this data is pretty broad intentionally. And, the next thing that we saw there is the beginning of interest rates start to decline in order to stimulate buyer
People's
interest.
Desire to buy,
But, what's important to think through in each of these eras, guys, is what was the psychology of the buyers and the sellers in each of these spaces, right? So obviously the psychology in the first market was it's a good time to buy a home and everybody wants to buy and buying's good, but we can take our time to do it.
Yep.
And it's pricey on interest rates, but not pricey. It's normal. This is what it costs.
This is what it costs.
You get to this psychology, I'm a bargain hunter. Mm-hmm. I'm looking for a deal. And selling is a necessary evil.
Like you only really sell if you absolutely have to, honestly.
And a lot of people absolutely had to because it was a financial crisis and they had no choice. They were being forced out of their houses. But the psychology is very important there. I won't get into those too, but I want to focus on the psychology as we start moving forward to think about what was the, really three different things. What was the buyer psychology? What was the listing strategy that you had to deploy? And then what was the, I guess, call it the style of sale. Like how did we have to approach this as a realtor? Yeah. So let's jump then to, many of you were around in 2012. And so from 07, 08, it was real crappy in 9 and 10. We were just struggling as a business to stay alive. Yeah. We were spending a lot of time just trying to like make calls to people that we owed money to that we couldn't even pay the bills and saying, we're good for it, but just not today. Hold on. And a lot of you realtors were in that same place. It was a tough time to be in real estate. And something unbelievably weird happened in somewhere around 12 and 13. One day, and I'm not even joking about, it was breakneck speed. One day we were talking about short sales, and a few days later, we were talking about multiple offers. Yeah. And just the amount of time, the amount of available inventory, prices dropping that far, the economy starting to recover, and then interest rates being at a place where affordability was so incredibly high that as things stabilized in the U.S. economy, all of a sudden the desire to own and the opportunity to own, it turned on a dime. Yeah. And that enters the next era, 2013 through 19. All of a sudden, we shift from a strong buyer market to our conversations in our team meetings are about how do we handle all these offers that are coming in? And we start brushing off skills that no one's learned before. Yeah,
they didn't have them before,
How do we handle multiple offers? Yeah. How do we facilitate like the speed at which these things are showing up when we list the properties? And it was a very interesting and fun time. Yeah. I think we were all still shell-shocked from the past, but all of a sudden we're dealing with 30 to 60 days on market, which is historically not normal. Yes. We'd only seen 90 and then 180 to 360. Yep. Now all of a sudden we're seeing 30 days and supply drops all the way down to 4 months. And so that's a complete turnaround. Inventory starts to decline, not right away, but relatively quickly. Yeah. No one's built anything. Yeah, because everybody stopped. There's no more new construction. Yeah. All the developers are bankrupt. Yep. And so no one's turned any dirt and no one's been building any properties for the last 5 years. We're severely
underbuilt in this place, I feel.
We're underbuilt and it takes a long time to turn that machine back on. Yep. And so new inventory is not showing up and the market's aflood with what's already there. And all of a sudden buyer activity goes through the roof and we start depleting the inventory. And it's crazy because, with rates now being highly stimulated, 3 to 4.5%, we'd never seen anything like that. Now, some of you are like, yeah, but what about 2.8?
Wait for it.
It's coming. Yeah. But this was crazy then. Yes. So just because you've got a even crazier crazy doesn't make this not crazy.
I think, the historical average is still in the double digits over a whole amount of time for rates. Like it's still double digits.
Anyone that sold in the 80s or 90s was accustomed to
14, 15, 16, 17. Yeah.
And so when we hit 3.9 and 4% interest rates, you can understand there was a feeding frenzy of buyer activity with everything for sale still. And we got really, really good at multiple offers. Yeah. And things turned very quickly. And by the end of that era, we started to see craziness happen in 15 and 16 because what happened is the developers had not yet turned the new construction machine on quickly enough. Mm-hmm. And now there's all this sloth of inventory, this giant, what do we say we had, like 11, 12 months supply, had slowly been depleted. And I think we lose track of this because we think of inventory in the post-COVID era. Yeah. But what we don't realize is that 17, 18, and 19, we had already seen a 30, 40% decline in normal inventory levels. Normal inventory, yep. And if you look at the chart, we're down all the way to 1 million. So again, 2 million was normal. We went up to 4 million. We doubled it.
And things were sitting, yep.
And we had come all the way down to 1 to 1.5 million homes before COVID happened. So we were already in the
super
beginning.
Super low inventory.
We had an inventory. I wouldn't call it a crisis, but it was starting to change the tide because all of a sudden now there wasn't stuff for sale. The buyer demand was still high because of all this stimulus for interest rates. Yep. And there was nothing to buy. Yeah. So if you were born quote unquote.
This is my era.
It is your era. You understand real estate to be a sport that's about speed, multiple offers, navigating how to prep the property up front to be super pretty, but but it doesn't really matter. Like it's more about setting it up to be awesome, so that there's a flurry of activity. It's mad chaos, and within 2 weeks, you pretty much expect to have sold something. And we had to take time to learn that. But what's happened along the way is our sellers have learned that too.
Yes.
Because there's where we were born, and then there's where all of these people, these consumers,
what they're hearing when they're actually ready to buy or sell, right?
Well, and when they entered the market.
Yes.
So when did they first buy?
Yes, exactly.
Some people bought and sold in the 80s, so they've got a historical reference point. But most of the consumer base out there right now bought their homes for the first time, either during the crash, or right before it, or after it.
Yep.
And all they know
is that point of reference.
Absolutely.
Yep. Now, I remember this. It's funny because I feel like my long time on market point of reference is that it really truly is that 30 to 60 days. Like I got a little bit of time to get some promotion and marketing and strategy with my sellers in, but then, but if it sat longer than 30, 60 days, there was something wrong, right? I mean, I don't have a point of reference really for a longer time on market than that. That doesn't make sense to me.
It's wrong, right?
Yeah, no, totally.
If it sits that long.
Yeah.
So the story from here, you all know.
Yeah. Most of our people.
I feel like my voice needs to get deeper now. And then we had COVID.
And then that happened.
And so what did we, by the way, we called the 2000 to 2006, I called the old normal. The 7 through 12, we'll just call the distressed or the crash.
Yep.
The distressed market. 13 through 19 is an interesting era because I wanted to call it the great sellers era because it was certainly a seller's market. It was a strong seller's market. It was seller leaning at least. But it was also a great time to buy. Mm-hmm. And during that period of time, although we were paying a premium for the real estate, we were buying it at a discount because of the interest rate.
Yep.
And so it was truly, guys, if you were born in that era, you got to know you entered into the heyday of real estate.
It was fun.
It was a lot of fun. It was good. And it was I wouldn't say it was easy, but the workload was front loaded on the listings. We had to be good strategists up front it was about speed and pace and availability. And your buyers, you had to be super available.
Ready on it.
If they called you and they wanted to see something, you knew you had less than 24 hours to look at this thing or it would be gone.
And we don't have this number on here, but I was thinking as we were processing all of that too, I think a lot of realtors did enter the market specifically in that time because of the change in real estate. Yes.
We doubled the amount of realtors. Yes. It was sub 700, it was 700 or 800,000 during the crash. And it climbed all the way to 1.5 million.
Yeah.
So we enter COVID. We expect the world to end.
Yeah.
We actually all go home. I remember
literally locked in houses.
Well, we thought no one was going to sell anything or buy anything.
Yeah.
And for a week it slowed down, and then afterwards we had a remarkable outcome.
We did.
And things kept turning. And it was because the psychology was that people now valued home more than anything ever before. One, because they needed to be safe and secure. They didn't want to maybe have a lease that was coming due.
Yep.
Two, home now was the place where you
just
worked.
Changed. Yeah.
Well, yeah, you worked from home. Home became a magical thing and super important. And the good news is that the prices were still affordable. The rates were still very low. Mm-hmm. And they were even more stimulated. So now we've got 2% interest rates, 2.9 up through 8. Well, let's get to the 8.
Let's say the 8's a different one.
So we know what happened there. Inventory tanks.
Yeah, everything's just eaten up faster than it can be.
And when we say tanks, guys, we're talking about levels that we've never, ever seen before. It's completely and utterly unsustainable, and it's asinine to have 350 to 700,000. Again, the reference point, 2 million in a normal market, 350 to 700,000 properties for sale at any given point. We started to measure inventory not by the amount of active listings, but by active plus what went pending.
Yes, we had to.
Because most properties, or many sales never actually saw the market.
The market, yes, completely.
So we have a massively stimulated, massively suppressed inventory, completely unrealistic environment that really is almost the final capstone that what the crash did to drive things down, this started to do, well, it drove it even further on the inventory side. And then in response to this, we have massive inflation. Yeah. We have a economic sort of crisis beginning. And all of a sudden, our rates go from 2.9 to 8%. And you can complain about that, but I think it was the right thing. And it stopped the crazy flow, and it pushed a little bit of a reset. And we didn't think it would happen as quickly as it did. But as rates got to 8, and now they've kind of settled back down to 6.97 is where they're hovering right now. Right. What this did was drive down buyer demand all the way to like 4 million units a year, down from 6.2 million a year. That's a 30-something% decline in sales.
Yep.
And as sales went down and builders had been building, all of a sudden inventory did start to creep up. And I'm trying to think what I need to say about what else on that before I jump to the new era.
Yeah, it's really, I was thinking too, just the sustainability of 30 to 40% year over year appreciation rates. That's not okay. I mean, it was beautiful for maybe the people that bought right then, because then they had this amazing instant equity that, wow, I saw 30% appreciation. But that is not sustainable. That's not normal. That's just
we saw
not healthy.
2 years of 20% appreciation.
And that's why the affordability got completely out of whack.
And it was a one-time blip, and we hope it never happens again. I mean, It was nice for the properties I own. But I think what's interesting about this era, it's a short 4 years, is it could be broken into 2 or 3.
Yeah.
Because the first half of that era was the massive decline of inventory and the ridiculous incentives on interest rates.
Yes.
The second half was the exact opposite. It's like a giant V, and we've seen inventory now spike all the way back up. We saw interest rates spike all the way back up. Call that a correction. I mean, if you think about the crash as a correction,
this was another one of those.
This was a correction in the other direction.
Second half.
And so many of you were born in this era, and what you've been accustomed to is 15 to 30 days on market, average. And here, most of our listings we sold within the first week.
Yes, absolutely.
And it was normative. Multiple offers was the name of the game. It was what we had to be equipped to do. It was the skill or the quiver of arrows that we had was about, especially on the listing side, prepping them up front. And we had spreadsheets for how to handle all the offers.
Yep, and a plan for the first 24 hours because it was going to be gangbusters.
Escalation clauses. Yes. Okay, so that is the what do we call that? The COVID crisis.
Yeah.
And I use the word crisis in that because crisis is a good word I think it's the Chinese roots of it. Crisis means, well, it's something negative but also opportune.
Yeah.
A crisis is about change, and inside that change there's an opportunity.
Yeah.
And what's shifted? So let's get to where we are today.
Yeah. What is happening now?
Where we are today is, I believe, the beginning of a new era. And I don't think I believe this in a bubble. I think you're seeing this everywhere now. I think KCM
for sure.
Altos. I think, just yesterday, Mike Meadler on CNBC.
Yeah.
I think this is now being understood broadly, quicker than we thought. Inventory levels have now crossed back into pre-COVID levels. Now that's still low relative to the earlier periods, but we're now nearing that 1 million plus units available, and it continues to climb. And so what we're going to is a place where the amount of properties for sale for the first time in a long time is inching back towards what they used to be back in the last
Early
time we had a normal market.
Yeah.
Interest rates are sitting at 6.9. We're expecting a couple of reductions maybe at the end of this year. And the more negative economic data we get, the more likely it is to happen. But if not this year, certainly next year, we'll probably see some reductions to the Fed funds rate, and we're going to see rates maybe drop into the mid-6s to low 6s, but probably not much more than that, unless we have another recession that's notable, which I don't think we will. And what that means is interest rates are heading back to a normal space. So we've got normalizing inventory.
Yep.
Which happened quicker than we thought.
Yeah.
And we've got really already normal
Normalized
interest rates. What we don't have yet is normalized pricing.
Yes.
But the good news is for the next 2 years, we're not going to see a lot of appreciation.
Yeah.
That's bad news if you own a house. It's good news if you want the market to be more stable.
Yep.
And we are certainly seeing price reductions start to happen. Where we're at right now, guys, just a data reference point for you, is more than 40% of all listings now nationally are taking price reductions before they sell.
Yes.
And I think it's 64% of all sales are now happening at less than asking price. So the days of properties selling at or above asking price are behind us.
Yeah.
We have a challenge right now where sellers still think that their properties are worth more than they are. And this always happens at the inflection points. Buyers realize, I'm not going to pay that anymore.
Yep.
Sellers haven't quite realized that, but they're starting to slowly.
Yeah.
And that's where we see that in the price reduction data.
Yeah, the normalized price reduction data, it's usually in that 30 to 35% range. And so now being at that 40% range, it is definitely more.
Which
than
again is normal. It's interesting because if you were around in era one, in the old normal, a price reduction was a very normative thing. It's what you did.
This is what we plan for. This is what we do.
First 30 days, you test the market. Second 30 days, you consider whether you need to make adjustments. Day 45, 60, you make the first adjustments. Very, very normal. But we come from a place where a price reduction means we failed. It means we priced it wrong. It means we screwed up. And this is what we need to talk about as a collective now. There's a lot of rethinking we need to do.
Yes.
And there's a lot of restructuring we need to do in our dialogues, in our conversations, in our planning with our sellers.
Yes.
So the era that we're heading into, there's a few more things we need to say.
Yeah.
One, it's incredibly confusing. Because there's two things happening at the same time. We are still doing multiple offers.
Yep, we have people definitely doing those still.
Some of our properties are still selling immediately and they're doing great. And there's a high demand out there still for good stuff. And there's still a lot of people with a lot of equity in their properties and they're cash rich. And if they find the perfect thing, they want to transact. And so we're still seeing multiple offers on some properties. At the same time, we're seeing 64% of these things sell at less than asking price and 40%
sitting and taking reductions. Yep.
So we're just going to call it a bifurcated market. And bifurcated, look it up, but it just means a fork in the road where there's two things
completely different things going on simultaneously. Yeah.
This is the reality. And this is very, very troubling because it means that the work that we've got to do, first of all, is more complex than A or B.
Definitely.
It's not binary anymore. We have to plan for both contingencies.
Yes.
We also have to help our sellers understand that both of these contingencies could be true. And we have to be fluid and adaptive as we now price, as we consult, as we discuss, as we watch, as we wait, because we certainly don't want to forego the opportunity for multiple offers.
Exactly.
And say, oh, no, it's going to take.
That's not going to happen.
Because then we look stupid.
Yes.
And we certainly don't want to not
overpromise.
100%. And so it becomes nuanced and it becomes far more strategic as we move into the environment we're heading into. Already, though, guys, I'll tell you that we are way north of 4, depending on the market and the price point. We're anywhere between 4 to 8 months supply now. And that is by all measures either a weak seller's market or beginning to be a buyer's market.
Yeah.
In many markets, it's now buyer leaning. The problem is the sellers don't yet understand it. And one more little nugget on this. We're going to see an interest rate decline at some point. And when we do, there will be another flurry of activity. And many people are going to go, oh, see, this conversation was wrong. Actually, it is still a seller's market. And I don't think that's true. I think there will be a slight flurry because of the demand and the pricing. But fundamentally, the tide has turned here.
Yeah.
And I think the big point here is, let's just jump into what's changed and what this means.
Yeah.
And so I'll run through the bullets here.
Yeah.
Inventory and financing are now returning to what is historically normal. Days on market is returning to a more normalized property sit for a period of time.
Yes.
This is not a problem. This is how sales work.
Should happen.
Buyer behavior, you've been experiencing this for a while. They're taking their time.
Definitely.
They're not as much in a rush. The psychology has shifted and they're finicky and particular because we saw 15 cancellations just last week. Some were financing related, most were inspection related. And what it comes down to is if I'm paying this premium at these interest rates, we've talked about this, it has to be right and perfect. And sellers aren't understanding this yet. They need to start being more liberal,
open-minded to negotiation on this stuff.
100% on their concessions.
Yeah.
It's bifurcated, which is an additional complication. Both things are simultaneously true. And if you can't handle two things at the same time, for those of you that are very black and white.
I am, yes.
This is going to be a tricky one for you. And then one final point, we as agents are behind. We aren't yet making the shift into this new environment and understanding the work to be done. And so some of the problem isn't that sellers have...
It's ours.
Well, the sellers have slightly outdated expectations, but so do we. And
we're not properly communicating and preparing.
There's a reset that needs to happen. And so I guess that leads us to like what we're trying to do here.
Yeah.
we know we've got to change some of our skill sets and capabilities with our clients. And specifically where we're going, guys, for the next several weeks is how do we guide our sellers? I know there's a lot of buyer changes we need to think through, but specifically, I think we're focused on how do we consult and guide and lead our sellers into this coming market so that we are experts. We've got to learn to set better expectations.
Yep.
We're going to have to brush off our communication skills. We're going to have to learn to be more purposeful and increase the frequency and even tone of our dialogue with our sellers. Mm-hmm. We've got to start being better managers of the whole process.
Yeah, because it's not just about getting it on the market anymore.
100%.
It's about a long-term approach.
And I'm just going to say it straight up. Most of you don't know how to do that. I'm not trying to be offensive.
It's just the reality.
And some of you think you know, but frankly, it's been 15 years. So look, give yourself a bit of a gut check on that.
Yeah.
And then we got to learn to price more strategically and more fluidly. We got to start thinking of pricing not as a fixed number that we've got to get right. We've got to understand that what we're doing is setting the stage for something to react to how the market is going to respond to where we are.
Yeah.
And then we've got to change our mental game as well. I think that there's a lot of our thoughts we've got to shift, but we're also going to have to get more resilient in learning to manage the listing process over a longer period of time.
Yeah.
Changes in the air. We're entering a new era and we want to get ready for it. We want to be ahead.
Yeah, definitely. I think Dylan's kind of already covered a lot of these things, but I think this is where we're going, right? So each of these deserve their own space and their own time to talk through. So we're really going to dig into how do we have those consultative, strategic pricing conversations and really data-driven, focusing more on what you're actively competing with than what's sold, right? Like there's just different ways to approach the data with strategic pricing. And my favorite words that we also use there are fluid and reactive. I think those are my other favorite pricing words, right? So it's not just about having the positioning conversation up front, but then it's also about having fluid mindset to this and strategic approaches to how the market is reacting and making decisions from there. So we're going to introduce some dialogues and things there for some skills to learn. Expectation setting is a big one for me here too. So you already referenced this one a few times, but one, check yourself, have your own proper expectations, shift your mindset on that first, and then be able to really help your sellers see a different picture for the proper expectations of how we're going to approach this. And it is interesting because you have to have both of those sides of the market in mind when you're having those conversations. We could have multiple offers, or we could sit the 60, we're going to approach it more maybe the 60 to 90 days, but this is where we could go, right? And the other part I really want to dig into, I'm excited about we've been talking about it. I feel like we did approach some of this a little too early on this year.
We touched this
right? We touched this in January, February, or even at the beginning of the year, and we're like, ooh, people weren't quite ready to hear it, but now they're feeling it. So I think
it's becoming real.
Yeah. So digging into this weekly communication, your system for that, to me, even more face-to-face, voice-to-voice conversations, because we really have to read the emotional and manage the emotional place where our sellers are, right? And it's not great and easy to do that if you're only texting and emailing updates, right? I really feel like we have to flip our scripts on this and really get in front of our people even more on a weekly basis, face-to-face, voice-to-voice, really manage those expectations and their emotions and their feelings through the process. And then just honestly, our process in general for this long-term approach of how we go about our listings and the consultation and then the process throughout. I think of the process before the process. We got really good at get it on the market and handle multiple offers and handle the pending process really well. Now it's a process before you even get to the pending process. And I feel like we really have to look at that beginning pieces of our skills and our processes and systems in that beginning piece too. So I'm super excited for each of these conversations and these skill sets that we get to relearn, or honestly, really learn for the first time with our people.
Yeah, and I just challenge you guys to be intentional about this. I know that it's busy right now. It's summer. We're all selling a lot, and it's not like things are broken.
No.
But if you've been around, and many of you have, and you've seen these changes start to occur, you've seen the opportunity that happens when things shift, because every time things shift, there's a group of people that are just frankly old and tired and get left behind because they're not willing to change.
Yes.
And there's others that are stubborn and obnoxious and just get caught off guard. And there's always opportunity in change. And
I'm excited for this change. I think it's the new normal. Change. I think it's great.
It's a good change. We could use some normal
skills. I feel, and it's exciting to me to have to dig into your skill set and reorient some of your habits, attitudes, and skills. Yeah.
And I'd suggest that in a 4 million units environment, which we've been in now for 2-3 years, which is notably suppressed. We're not selling that much real estate. We're crushing it. And some of you are having your best years by far. We've got so many record sales years going on in our organization, but you're doing that in a suppressed environment. And what I'm suggesting is that the negativity that could be perceived in prices are starting to fall, properties are sitting for longer. That is one way to frame this. The other way to frame this is we're entering a more normal environment that's going to facilitate and open doors for sales volume to increase again.
Yeah.
And when the market goes from 4 million to 5 million units annually, guys, that's a 25% increase in sales. And right now, there's not a lot of new agents entering the market.
Yes.
There's an opportunity. Someone gets that market share.
Yes.
And I think the people that get that market share are the ones that have put on their work boots and decided to be intentional about where the puck is going and not be too focused on where it is right now.
Yeah, I was actually just picturing that shift chart in my head from the shift book, the market share, right? Like people in those downturn markets who really focus can really overtake a lot of market share. And I think this is a really cool opportunity for some of our people to do this.
Yeah, so in closing, I think on this little 40-minute intro so far, I'd have you guys just ask yourself some questions.
Yeah.
Where did you start? And wherever you started, what core assumptions, what frameworks, what neural programming, what expectations have been kind of hardwired into your thinking now?
Yep.
What assumptions are you making about the market that really aren't reflective of a normal market? Like
right.
Where you have habits that you've built that you may need to reconsider.
Yep.
And even now, are you seeing the shift? Can you see how some of those things are going to have to change? I think the point I want to make here again is that the wrong way to look at this is, oh no, the market's getting worse. Oh no, they're taking longer to sell. This isn't about a good market turning negative. The truth is it's been a crazy, crappy, ridiculous, asinine, unsustainable market, guys, for a very long time.
Yep.
And it felt super normal and sweet from 20, what was the middle era, 13 through 19. And it was a good time, but there was a disaster looming that whole time. And it wasn't just COVID. Those inventory levels were already becoming a problem.
Going to be a problem, yes.
And I'm going to tell you that 3% interest rates are always going to be a problem. When people are giving away a whole bunch of stuff for free like that, it's because underneath that, something's going on.
Yep.
There's no, what did it say? No free lunch. And what was going on was the market wasn't healthy and it had to be stimulated. And so it's been a rough couple of years. It's actually been really good.
Yeah.
It's weird. When I say rough, I mean the market's been rough.
Yes.
But we've actually been thriving as a collective and our agents have been crushing it. So we're not talking negatively here. There are fundamental changes afoot. And what I want you to think about is your skill set. I want you to think about your habits and your skills. What do we need to either learn for the first time or relearn because it's been 15 to 20 years so that we're prepared for where we're headed. We've got some reflection questions for you there. I'd say this is a fun intro. I think that we'll be discussing some of the actual eras in team meetings this week.
Yep, we will.
Just to open this up some more. And then every week for the next several weeks, we're going to be jumping back in and getting real practical on some of the topics that Angela was mentioning there, along with resources. We're pulling out a bunch of our old resources.
Yep, refreshing them
to make sure that you guys have access to that. And I think that this is just a fun, timely,
very timely
topic. And one more time, I'm going to challenge you all to decide to put your work boots on. And nothing drastic has to change today. I know we've got lots to do this summer, but we're really going to put our work boots on coming into the fall and make sure we're ready for hopefully several really fun years of normal market.
Yeah.
So
I think we're going to win relationally, and then this is just going to hone your skills and go move you in the right direction. It'll be great.
Good stuff.
Yeah.
Fun chatting with you about this. It's it almost feels...
I can't wait for what's next.
Well, it's weird to look back that far. I feel old. Does anyone else feel that listening along? But onward and upward, guys. This is going to be fun.